So, talking about multifamily and why I love multifamily, and kind of how I'll start with how I got into it, sort of by accident. In 1982, I was working as an engineer and went to buy a house because I was getting killed on taxes. And at 19% interest, I couldn't qualify. So I ended up buying a 6-unit. And that is someone who's lost. No, that's a broker.
They are lost.
They're lost. So once you hit 5 units and up, they use the income from the building, not your income, to qualify. So I remember being at a meetup not too long ago. One of the guys who present a lot, and he made the statement that it's much easier to get a loan on a single family than a multifamily. I go, that is not true. And so a nice debate in there. Obviously, once you get into the bigger, 100, 200 units, it gets more complex with agency loans and stuff like that. But I've always found multifamily to be easier to work with than single family, so that's my bias. But anyway, just starting out, my company, Financial Attunement. I've been a loan broker for almost 30 years. Had a client who came to me to refinance her condo in San Francisco. It was being rented. And she had a $200,000 loan on a $1.2 million condo. And I'm looking at it, she's got $1 million of equity. And I'm asking, so why are you hanging on to this thing? Well, it's cash flow positive. I go, yeah, you're making $3,000 a year on $1 million equity. That's 0.3%. You think you can do better? Yeah, at the time I wasn't doing what I'm doing, and I referred her to one of the hard money lenders that I knew, and she started making 12% on her money. And 110,000, 112, 20,000 is a whole lot better than 3,000, and she loved me. So after 2008, when the mortgage industry kind of imploded, I had a loan brokerage among other businesses. I was going, okay, now what? And I went through many webinars and kind of played around and came right back to multifamily. And so the whole point of this, and I'll kind of start moving forwards. So it's like all of us need to look at what we're doing with our finances. And I'm going to try to stay on the slides instead of ad-libbing, which is difficult for me. But basically, the whole thing is about checking what you're doing with your property, with your assets, and having your assets work for you instead of you working for them. So, financial attunement is the art of fine-tuning your finances to really, fund your dreams and allow you to retire, replace your income, replace your active income. And the sooner you can do that, the more you can have fun with what you're doing and not be a slave to the job. How many of you have a job? Okay, and the others of you, how many are full-time real estate at this point? Cool. Okay, got a nice range. So, part of what's happening is we need to start having conversations that our parents never had. In 1900, life expectancy was 46. So you basically worked until you died. In 1960, that went up to 66. So your nest egg had to last 6 years, or however it wasn't. Now we're at 84 and climbing. So all the pension plans, all the Social Security system, everything out there is designed to last to 66 or 65. And we've got constantly improving medical technology and constantly increasing bills for that technology. It's the whole system is not sustainable, which is why there's all the politics around that. So the only way you're really going to sustain the life that you want is by doing it yourself. And we do that through real estate, obviously. You really have to take what you're earning, put some money aside, and build it. But you have to think about the time value of money. Time value of money is a very simple concept. Would you rather have $1 today or $1 30 years from now? So if you take $1 and invest it I'm going to use the numbers on here because I've bounced between, but if you take $100 at 2% and invest it for 30 years and don't touch it, you end up with $182, which isn't a whole lot. At 10%, that grows to a whopping $1,984. But at 18%, you're at $21,000. Okay, huge difference, so it's exponential. Looking at it backwards, if you want to start saving today to generate something that will yield $15,000 a month to live on 20 years from now, you need to save $33,000 a year. $33,000 a month at 2% to get there. Most of us can't do that. At 10% interest, it drops to $2,300, sorry. And at 18%, you're down to $433. Little spread. And looking at it the other way, if you have $50,000 to invest now and invest it again at the 2% versus 18%, you can tell the difference. I mean, you're talking 130,000 versus 1.3 million. And that's, you know, it's magic of numbers, magic of compounding. But of course, you want to do that safely. As soon as you lose your nest egg, you're toast. So, as many of us were in 2008. So, the key that we found is multifamily real estate, or pretty much any commercial real estate. And one of the things we've done is, you know, through the downturn, as I'm trying to figure out what are we doing, how do I reinvent myself, I'm seeing this, you know, this massive transfer. It's probably the largest transfer of wealth in history. How do I get myself in the middle? And I look at what the institutions are doing, and they're buying, you know, large commercial property in markets that are going up and making like ridiculous amounts of money. And I go, well, how can I do that? How can I get myself in the middle of that? And I can see buying one unit, but I don't have that much capital. So then what came about was the whole concept of syndication, which is basically, you know, taking lots of people who want to do the same thing, taking $50,000 or $100,000 or $200,000 from each, pooling our money and buying institutional grade investments, which is really cool. So I'm not going to read the slides. You guys can read. So by pooling our capital, we can go after these assets. And where we start is with the market. And you know, going back, you know, when I was in San Francisco investing in, you know, small units, 6 units, 15 units, I always thought that market cycles were something for other places. San Francisco was just up. This was a 6-unit building. I can always fill 6 units. It's not 200 units. I'm not chasing tenants or doing all this other management stuff. But when I bought my first unit in my first building in 1982, we were really at the bottom of the market with 19% interest. No one was buying. And a year later, interest rates had dropped to 12%. And I refinanced that first building and pulled out 4 years' worth of engineering salary. I said, I'm not going back to my job. But in '87, I was working on a 15 units. We did that one. I had a construction crew at the time. We did it really efficiently, controlled our expenses. It was a really cool deal. And then 11 of the 15 tenants moved back in at their old rents, which were between $100 and $250 a month. And I went to the rent board to adjust the rents, and they said, well, the law allows you to do this, but we're going to give you 10% of what the law allows you because we really don't understand math. They didn't say that, but that's my ad. So I took them to court. I won, but it took me 2 years to get there. I was paying the attorneys. I was rolling my construction loan over and over, paying points each time. In '87, if you remember, tax laws changed. And in '87, the market was doing this. In '89, the market was doing this. So I learned what market cycles were. And despite doing a really good job on this, I actually lost a little bit. I mean, it was like $15,000, $20,000. It wasn't big. But I had had the property in escrow subject to the rent board approving the new rents at $1,365,000. And I sold it for $865,000. So instead of making $500,000, I lost 20 or 30. So we start with the market. And right now, given what happened over the last 8 years, whatever, There are 40, 50 what are considered emerging markets. And an emerging market is really just anything that's going up through really strong labor growth. So if there's strong job growth in a place like the Bay Area, values are going to go up. You know, obviously there are many other factors. If you look at San Francisco, between San Francisco and San Jose, the whole Bay Area, 110,000 jobs were created last year and 7,000 housing units. Where are rents going? Where are values going? Up. Okay. Same thing in Houston. The Houston Metroplex, I'm sorry, the Dallas-Fort Worth Metroplex is 120,000 jobs a year coming into the area. Houston, I think, is about 105, 110. So those are good areas to invest in. If you go to Detroit or Fresno, I mean, Fresno, you look at the cap rates actually look more like California cap rates, like Texas cap rates, but there's no growth. There's nothing driving the engine. So I'm not investing there. I'm investing in Texas, for example. And then the really cool thing, and I'm kind of jumping around here, but let me see if I can find it, but I should stick to my presentation.
You're happy we have a small group.
Yes, it is a small group. I can play. So why do we like multifamily? I mean, I go back to common sense and math. So common sense, I'm just going to kind of read. You know, you've got consistent investment returns. On a single family, if someone moves out, you're 100% vacant. On a 200 unit, if someone moves out, I'm 0.5% vacant, or less. You know, there's constant turn. You know, typically we have positive cash flow from day one. If we don't, we usually don't buy it. There are some reposition properties that we buy. Reposition, we're going to expect to have positive cash flow within a very short time, not 2 or 3 years. I don't buy vacant. Those are a little too risky. But I'm actually doing a loan for someone in East Atlanta. 138 units, 12 units burned. So 12 units burned. The guy's fire insurance went through the roof. So he's paying $110,000 a year for fire insurance. Our buyers have a quote at $52,000. So there's a little savings there. They're using 8 employees for 138 units. I would use 4. So there's some savings there. And they have broken water lines. Their water bill is $120,000 when it should be $40,000. So you go in there and you replace the water lines. You fire 4 employees, or you really fire 8 and hire 4. Get the regular insurance in place and put $400,000 into rehabbing those 12 units. You've just changed your NOI, your net operating income, by $280,000 overnight. So the really cool thing about any commercial real estate is valuation is directly proportional to your net operating income. So if you can figure out how to make your bottom line go up, if you can increase rents by $25, your value goes up. So if you change the value by $280,000, even at a 10 cap, that would be $2.8 million. At an 8 cap, it's probably $3.2 million in value. So these guys are buying it for 3.9. They're putting 800 into it, and it'll be worth 7 point something. So those are the kind of deals we go after. Rehabbing 12 units is easy. Rehabbing, 600 units in a complex is not. So economies of scale. On a 6 unit in San Francisco, who gets the call for the locked out tenant in the middle of the night? I do. Toilet leaking, I get the call. I'm plunging toilets. I'm unclogging drains. I'm painting. Over here, with 150 units, which is kind of our target, 150 and up, you have a property manager, an assistant manager / leasing agent. You have a maintenance guy, an assistant's maintenance, maybe a third maintenance or a porter. They are doing everything on the property. And I'm not even employing them. They're employed by a management company that runs everything, all the payroll, all the training, everything else. And every Monday morning, I get a report from the management company. It tells me how many units are occupied, how many are vacant, how many units are going to turn over in the next 30 days, how many of those have already given a notice to vacate or committed to renewing the lease. So basically, in 30 to 60 minutes a week, I can manage a 300-unit property. It takes me longer to manage the 6-unit property I'm living in than a 300-unit complex. That's, 1,500 miles away. The other thing also is on a small complex, let's say you buy 20 units, you don't really have enough rent coming in to cover a manager. Certainly not a manager and a maintenance person. So you get someone who's good at maintenance or you get someone who's good at management. And if you're finding one that's good at both, they're probably not doing that job, they're getting paid more elsewhere. But on a bigger unit, on 200 units, you can find some really quality people that love what they do. They can take a building from kind of a ho-hum, performance to really stellar performance. So one of our buildings in Longview, Texas, we inherited a manager that wasn't great. We tried her for 3 months, didn't work. Made another hire. Last minute, that didn't work out. Made another hire, that didn't work out. So for a month, we were kind of lame ducks. The old manager knew she was leaving, but we didn't have a really strong new manager. We got a new manager finally, didn't work out. Got another one, all of a sudden the thing turned around. So in the first 9-10 months, we had raised rents maybe $25-30. Then it's kind of sat, and then 2 months after our new manager Jesse was in place, we raised rents $25, and the next month we raised another $40, just because the place was running well, and there was rapport, there was community spirit. So at the plan on that one originally was to raise rents by $100 over 3 years. We did it in 19 months. And you can't do that without the right manager. And you can't find the right manager on a 6-unit because they're going to be running 15 or 20 or 50 different properties. So the other thing also, if you look at a single family P&L, income and expense, there are a few items on a property like this, on the income expense figure, that don't appear on single families. When you have to replace the roof every 10 or 15 years, where does that money come from? So there are CapEx expenses that are pulled out every month. We pay $250 to $400 a door, depending on the age of the building and the quality, just in reserves. So you're building up the reserves. Your leasing agent that's on site, that's part of the salaried staff. Your single family, when that turns over, you're going to be vacant a month and you're going to be paying someone half a month to a month's rent as a commission. That's never in the calculations. Okay. Managing, sometimes they have management fees. Management fees here are 3 to 4% on the larger properties. On smaller ones, you're paying 6 to 12%. So everything is just less expensive per door. Capital improvement reserves are covered. Strong capital growth. So the capital growth, again, just as we're specifically targeting mismanaged properties. So when we go into a market, we're interviewing property management firms. So you want to find the best manager for a specific type of property, because the best manager for an A property is going to be a terrible manager for a C property. Okay. Everyone know the difference between A's, B's, and C's and D's, asset classes? Okay. So typically, something 10 years old or newer is an A class. B is 10 to 20, C is older, and D is more like a war zone. So you don't really want to collect the rent at night. And typically, the older the property, the more work it is, the higher the return is going to be. But if you have a property manager that specializes in A's, they're going to be really high customer service. And there's a nick on the front of the refrigerator. Okay, let's put in a new $800 refrigerator. For a C property, I want the guy who's going to go find the A manager and buy his refrigerator that he's replacing and put it in my unit for free. If he's buying an $800 refrigerator, he's out of there. So it's just very, very different. So the manager that we have, like we're buying a property in Dallas right now, primarily Hispanic. The manager we have specializes in C-class Hispanic properties. So, when they all go home at Christmas, I mean, they know that rhythm, and they know how to talk to the tenants, and they know how to do all that. And, there's certain maintenance items that are more hot buttons for different demographics. Once you specialize in that all works. There's something else I was going to go there, but it'll come back. So levered returns. When a property increases, let's say we buy a property for $5 million and increase the operating income, and it's now worth $6 million. So it's gone up. I'm going to simplify the masses. It's gone up 20%. It's not quite, but close. In fact, on that $5 million property, we bought it with a $4 million loan, and we put $1 million of equity into it. So in fact, the increase to $6 million, we actually increased by $1 million to $2 million, so we actually had 100% return. So on most of these properties, we're getting 75 to 80% LTV loans, and basically leveraging the market. So when you go into a market that has strong, like 3 to 7% rent growth, and you're leveraging it, you can double your money, your equity, fairly quickly. Going back to the managers. So when we go into a market, we're looking for the best manager for the asset class, and we're also looking for the worst managers. Why? That's my that's my purchase target. I want to know what properties they're managing, because those are the ones I'm going after. That's how because if you buy based on net operating income and it's mismanaged, and I'm looking at something that has a $400,000 income and I know I can make it $700,000, I know I can make money on that property. So most people don't think about that, but asset protection. When you buy a single family house, I mean, most of you, I don't know how many of you went to, well, we just came out of 3 days of an asset protection seminar. I don't think anyone here was there. Alexi. But if you're not familiar with asset protection principles, you need to find a seminar, and I'll be sending out emails and stuff. But basically, when you buy a single family house, you shouldn't be buying that in your own name. Buy it in an LLC, and there are different ways of structuring the interrelationship between the entities to maximize tax deductions, minimize your exposure, and play with estate planning. So on the multifamily, we're doing that very safely. Most of the loans are non-recourse. So unless we are fraudsters, if 2008 hits us again, we're relatively safe on that. Professional management, we talked about that, and all you do is cash your checks. So, looking at a scenario, if you have 100 units, and I was covering this a little bit. If you buy it for $3.5 million, net operating income is $280,000. If you bump is everyone familiar with the concept of cap rate? Anyone not familiar with cap rate?
Heard it, but not very efficient.
Okay, so cap rate is basically the net operating income divided by the value. So if you have the net operating income and you have the market cap rate, in general, people are buying this asset class at, let's say, an 8 cap or a 10 cap, you can figure out what the building is worth. And then from there, if it's a very appealing building, you might pay a little more. If it's a less appealing building, you might pay less. If there's a huge upside to it, you're probably going to pay more for the building than the market, just based on market cap. But again, that's kind of, you start with the market cap and see where that would, if the building were operating properly in this market, and that was the return, that's basically where the value is. So buying this at an 8 cap, you get an 80% loan, $2.8 million. You put $700,000 into it. Total investment, let's say, with repairs and fees and everything, about $1 million. Property value, we talked about this, is directly related to NOI, net operating income. So if if the rents go up $25, that's $2,500 a month divided by 8, or times 12, $30,000 a year divided by 8, 8%. $25 is a $375,000 gain. So remember your down payment was $700,000. You basically increased $25 of 37.5%. I said that you had $1 million invested. You just made $375,000 for a $25 bump. So you just had a $37.5 return for a $25 bump in the rent. You like that? So when we're looking at these things, I mean, there's so many different value plays. I mean, there's a 380 unit in Tulsa we were looking at. They were redoing the highway in front. So access was awful. And occupancy was down at 84%. Every property around there was at 95 to 98% occupied. And the highway construction, we went to talk to the engineers. Construction was due to be done in like 6-7 months. So in 6 or 7 months, we're adding, what's another 10% of 380, 38, 40 units income. So that's an easy value play. The fire units we talked about. There are so many different things you can look at, ways to increase the rent, in addition to your rising market, because remember, we're in those emerging markets. So on this one, if you have a $100 a month increase like our other property, you're 37 times 4. Very nice returns. So very small market improvements, give you really huge back-end profits. So some examples, the 172 unit in Longview, talked a bit about that, but we bought that for $5.4 million, end of May 2013. And these numbers are old. We're now $100 over, and we just got actually 2 agents that are looking at it to list in the spring. Came in at 7.2 and 7.3 million on the value. So I had $1.5 million invested in that. Take out commissions, take out the manager's split. The investors have pretty much doubled their money in 18 months. Well, it'll be 2 years by the time we sell it.
How many investors were involved?
I think I had about 17 on that one. Typical investment is 50,000 and up. So on that one, we had one investor at 500,000 on that one. That was the largest, and 50,000 was the smallest. So there's another one that we bought, 224 units in Houston. We bought a year ago for 7.8, and we just got an unsolicited offer on that at 10 million. So we had 2 million invested in that one. We've pretty much doubled, and we're evaluating whether to take that offer. It's pretty tempting, because we can sit on this at with cash flow at 10-15% annual. But if I'm doubling each year, and I find we've now done 2 doubles, and our little Tulsa property is well on its way to do that as well. I'd rather be doubling than giving 15% returns. But these are very fun projects to put together and see what comes out of it.
All the investors have to agree, or just the majority?
No, typically the management group, the way it's structured, the management group is running it. There are three of us as a core. Each of us has 30+ years in real estate. So we rarely have investors that have more experience than us. We'll certainly talk to people, and if anyone has a major concern, we'll look at it. But in general, the management group is who's deciding.
If you don't sell, how are the NOI distributed?
So typical distributions are quarterly. On the larger properties, if there's a HUD loan, HUD mandates a semi-annual distribution rather than quarterly. But we just have one of those, and that's kind of not the norm. It's more on A properties, and I shy away from A's. One of our early ones, I put some investors into an A property that a friend was doing, and this was outside of San Antonio. And it was going great until someone decided to build a building across the street. And we had a 400, this thing is overlooking on a bluff overlooking the river. All the windows overlooking the river have an AC unit in them. If you open the window that's holding the AC unit out, the AC unit falls out. So you can't clean the window and all the spider webs in there. So they have a view of like a whitish pane and no river. So you look at stuff like that and go, yes. And we just go in and clean them up. And it's amazing what you can get. The 380 units needed new appliances. I mean, they were in pretty bad shape. We went out and we put appliance packages together. Refrigerator, stove oven, dishwasher, microwave, delivered to the door, $865.
Wow.
I mean, I have refrigerators in some of my units in San Francisco that cost more than that.
Yeah.
And this is the whole package, in black. It wasn't stainless steel, it wasn't white, but you know, it's pretty amazing what you can get when you buy in bulk. So right now in Tulsa, we have 27 air conditioning units sitting on our roof. And our AC guy is slowly working through, you know, one unit at a time as they turn over, you know, putting in central air.
Your tenants are there while you're rehabbing it?
Yeah, yeah. It depends, you know, like the 250 unit that we're buying in Dallas right now, the seller was doing the same thing. You have someone in an older unit, when you buy a lot of these buildings, they're you know, 20, 30% vacant. So you start upgrading the vacant units. And then we have a nice dolled out units, you know, market rent is, let's say, $600. And you have someone living in a really nasty unit at $400. It's like, well, why don't you move over here? I'll give you a concession on the rent. I'll move you over at $500, and then we can rehab that. So next time the lease is up, you can bump them to $550 or $600, bring them back up to market without them leaving. So you just slowly move people around in the building. So you still have a few that aren't done here and there, but most of them are done. And you can just you know, you just kind of move around like that. And it doesn't always work. Sometimes you just leave a unit undone, and you sell the unit that way. And you sell the building with that. So yeah, the 152 units we talked about. So actually, the other way to play around with this, and this goes back to the Tulsa one. We're buying a C- building in a B+ area. The cap rate is going to be higher for a lower grade building. So as the cap rate falls, the value goes up. So if we take a C building that we're buying at a 9 cap and we make it a B+ that we can sell at a 7 cap, we have not only the increase of the NOI, but we also have the multiplier effect of the cap rate, which makes it really cool.
What's the, I'm not totally familiar with the difference between A, B, and C, and you said age, but obviously
Okay.
there must be other factors.
There's quality of the building and quality of the tenants. So I mean, you can go to New York and buy an 1800s brownstone, and that's an A property.
How do you know whether sellers are misrepresenting the class that it's in or something?
You look at it. You look at it.
It's a subjective thing?
It is subjective, but not that. I mean, the way I look at it, real estate agents are salespeople. I won't quite, well, I can say realtors are liars, but especially on the commercial side. You know, it's like everything they tell you in the prospectus, I verify. And I have property managers in Dallas. Hey, can you go look at this building for me? All right, we're looking at one in Waco. I called up another property manager. Oh yeah, I went to school in Baylor. I know that building. I used to manage it actually. Don't buy it. Okay, next. And I don't have to fly down there. When they tell me yes, it's a good one, then I'll fly down. But we look, once it's in contract, if it's 248 units, we'll typically see 242 of those units. There are always some that we miss, but we'll look in every single one. And there are some that are interesting. I mean, there was a 41 unit in Oakland that I looked at. And the manager's unit, the guy was a hoarder. I don't know if any of you have been in a hoarder's apartment. I mean, this thing, floor to ceiling, I don't know how he lived there. I don't know how anyone lives in these things. But literally, I mean, to get in the front door, it was like you're kind of moving around the door, and then you're like climbing over stuff, and I mean, you got to clear it out. So we don't like surprises. We look at every unit as much as we can. So, so Silicon Valley Associates, where we are now, actually is, I'm an associate broker here. There, if anyone in the San Jose area needs real estate, has real estate needs or looking for a good agent, I can, we can connect you in here. But that's kind of an aside. I'm one of the few people doing commercial stuff down here, but I'm trying to reform them. So the way we typically structure our deals, going back to the asset protection, we'll typically have a holding LLC that owns the assets and a management LLC that manages it. And then within the management LLC, you'll have, my partners and I, depending on what our roles are in each deal, we'll have varying degrees. One of the managers qualifies for the loan. So when we're buying a $6 million property, we need to qualify for a $5 million loan. So one of my partners has the deep pockets and the clean track record, a clean credit report, which I no longer have after '08. In '08, I owned a mortgage brokerage, a prefab house factory, and we had a 507-unit subdivision going. A 507-unit subdivision we were building out. '08 was not pretty. So everyone got paid eventually, but it wasn't pretty. So so the way we structure these, typically the management team will take a carve-out, 25% to maybe 40%, depending on the amount of work. And then the investors get first 70% distribution. Let's call it 70-30 for ease. So the investors get 70% of the cash flow and 70% of the back-end profits, and then the managers get the rest. Depending on the property, and each one is going to be a little bit different. Sometimes usually there's a preferred return. So before the managers take anything, we make sure that the investors get 7 or 8% or whatever is on the deal.
So does the NOI include that split, or not necessarily? Probably not necessarily.
So NOI.
Or the cap rate, I should say.
Well, no, NOI is closer. So NOI is net operating income, so it's income minus expenses, but expenses do not include capital reserves and do not include debt service. So your loan payments are not in there. So we're not distributing NOI, we're distributing distributable cash, which is NOI minus mortgage payments, minus capital reserves, minus any operating expenses, so our annual fees to our various entities, registered agents, stuff like that. Those are minimal. So at bottom line, you've got supposedly distributable cash. If we're rehabbing, like on the Longview deal, I made a mistake when we read the documents. They had quarterly distributions instead of monthly distributions from our CapEx reserves. So we were doing $350,000 worth of improvements in there, and we had to wait 3 months to submit, and then 2 months for them to turn it around. So we were carrying $150,000, $200,000 of repairs on there. So we had figured we'd distribute probably 10 or 11%. We've been distributing 8% just to stick with the preferred return and not taking any manager distributions just to get past that. Now, going through that, we've accelerated, in 19 months we hit our $100 over start rate. And we finished our improvements, and now cash flow is improving, and we're like at 14%.
But so if you had a cap rate of 8% and 30% of that goes to management, then that's sort of, to an extent, diluting what goes to the investors. But you make up for it in the expertise, and then you guys are assuming the liability of getting the loan and all that, right? Is that how it works out?
Right, yeah. So cap rate is a measure in the market of, think of cap rate as think of a building as a black box.
Right.
So what kind of return does this black box churn out unencumbered of debt? So regardless of debt, what does this building kick out? And based on that operating income and the cap rate in the market, you can figure out what that thing is worth.
Right.
So the cap rate is kind of like a market measure.
Right. But if I was looking
So-
at 2 buildings and they both had the same cap rate,
Right.
and I bought one by myself, and then I
Okay.
bought the other one with a syndication,
Right. So
I'm
you're
gonna have a less of a return on the syndication.
Correct.
But I have to
Okay.
get my own mortgage and do my own homework
Right.
on the one I buy
Right,
myself, right?
yeah.
Okay.
Oh, so the investors are not on the note.
Investors are not on the note, no. I mean, if everything blows up, the investors can potentially lose their investment, but nothing else. You're essentially limited partners. The managers on the other side are doing a lot of work.
But the managers aren't necessarily putting up capital, right? They're doing
No,
the work and getting the
Right,
mortgage.
not necessarily. I mean, if I have capital, I put it in here because I'd rather have it grow here at 20 to 50% annually than at 0.2% in the bank. So, but a lot of our capital gets tied up. I mean, every time when we write an offer, we put $50,000 into escrow, and we have another $50,000 following it in 30 days. And then you're paying the due diligence fee. So you have your contractor's inspection, $7,000. You have your property manager's inspections, another $4,000. Then your roof inspection, and then you pay the attorney for the syndication paperwork. And I mean, we're easily out $100,000 in fees just going through due diligence before we know that we're going to close. And we've pulled the plug many times, and we have 20,000 or more already shelled out. Once worse than that. We try to avoid those. So no, all the risk, and if when we close, we know it's a good deal, and we've basically looked at everything on that building, top to bottom.
PPMs you see on what's a month or how often?
How many do I look at, or how many do I produce? Or? I mean, we look at probably 500 deals a month. I won't say we look at 500 PPMs, but I look at 500 apartment complexes easily. Of that, we'll close one every 2 or 3 months. So I'm trying to accelerate that and make it a little more streamlined. But for now, it's my lips are sore from kissing so many frogs, looking for the princess.
How is that, what's it trending? Is it harder? I imagine it's harder with the cap rates lowering.
On the one hand, it's getting harder. On the other hand, our reputation is growing, so people are calling us with deals. And part of it also from being, I've been studying with Dave Lindahl and various other, gurus out there. I will continue to go to Dave Lindahl stuff, for example, not necessarily to learn more from him, but I'll always learn something. But because everyone in the audience is looking for the same thing I am. And so if we can help each other, it's just a wonderful community. So the 138 unit in Atlanta is a Dave student. I've known him for a few years. And he needs a loan, I'll get him a loan. He needs equity, I'll find him equity if I like the deal. So I see a lot of students, just sending me deals and say, yeah, it's okay, deal, I'll get you a loan. Oh, that's a kick-ass deal, what are you doing for equity? So I wouldn't call them bird dogs really, because some people just find properties. These guys are really putting the deal together, they're syndicators. But we all help each other, it all works. So that's pretty much the end of this part of the presentation. Questions or, yeah?
Do you guys handle VA home loans?
I am a loan broker, so I can do that. I used to do it. I've done maybe 20 home loans the last 3 years.
No, I'm saying VA home loans.
Yeah, a VA, any kind of home loan.
Okay.
But I don't do many of them. I'm probably not your best source. There's a guy here, Mike, that I probably give it to that
You
he's.
can actually get a quad flat from VA home loan.
Yeah, yeah. But part of it is, I mean, I can help you, and I'll work with Mike in the office here. We can do that. It's just the loan process on the residential stuff. So basically, 1 to 4 units is so paper intensive these days, and I'm traveling too much to stay on top of paper, so I have to rely on people here to do that part. But so we talk about multifamily. I mean, commercial multifamily is 5 and up. Residential multifamily is 2 to 4, and there are differences. but we can play with that. So,
What's the difference, so I imagine you're a broker, right?
Yeah,
You're-
yeah.
But what's the difference between, I understand on the residential side, but on the commercial side, the difference between going through a broker or a direct lender? Do you have recommendations or feedback on that?
The process of going through a commercial mortgage is typically going to be 60 to 90 days to close. If there's a hiccup partway through, you have probably 200 documents that you've given them, and you think residential is bad. I mean, they're looking at the laundry lease, they're looking at the vending machine lease, they're looking at the tenant leases, they're looking at the roof repair, all your, looking at the tax return, the tax bills. I mean, they've got, I mean, my Dropbox is just over, full. If you have to rebuild that and resubmit to another lender, if you're not working with a broker, it's going to take you a lot longer. The other thing, I mean, but when you first go into a commercial deal, I mean, most of the stuff that we try to do is Fannie or Freddie, and it's so the kind of the big ones are Fannie, Freddie, HUD, and CMBS, commercial mortgage-backed securities. And commercial mortgage-backed securities are some of the more flexible ones. But what I love about Fannie and Freddie is that when you sell the property in 5 years, or if you rehab it, you can get a supplemental loan behind it. They will essentially do a second behind their first. So especially today with the interest rates so low, we're actually putting 10-year loans on here even if we're planning on holding it 3 to 5 years. Because rates are so low today that we're figuring that 5 years from now, rates are going to be higher. And if we're selling with a 4% loan in a 6% market, that's a bonus. And we're going to get more money because the NOI is better. The distributable cash is better. It doesn't affect NOI. With CMBS, they don't allow that. With HUD, they don't allow that. So if you buy a building at $5 million and you sell it for 10, let's be optimistic here. Someone has to come in. You bought it for 5. You have a $4 million loan. The guy, if he wants an 80%, needs to come up with $4 million. Actually, he really needs to come in with $6 million to close it. You're going to lose some buyers for that. If you want to carry a mortgage, carry a second to make it work, you can't record that against the building under HUD or under CMBS, typically. So then you're carrying what's called a soft second. So you're securing the shares in that, and you can't foreclose directly. So if we have to do it, we'll do it. But I like Fannie and Freddie. And typically, if I have to go CMBS, I won't get a 10-year deal. I'll get a 5-year deal.
I know in residential, we made this mistake with the house. You can't cash for the house and then try to refinance it after the fact. It gets all confusing as to whether it's a purchase money loan or refinance. So in commercial, is it common to maybe try to do cash deals or get bridge loans to close quickly and then try to refinance with a more permanent loan?
Yes.
Okay.
So number one, never buy all cash. If you're going to buy all cash, have your company loan you the money and put a loan on it. Because now it's not a cash out refinance, you're just replacing the existing mortgage that it happens to be to yourself, but you're replacing an existing mortgage.
So
That's
even on
commercial
they look at it
that's
that way.
commercial or residential. Now, there are many commercial bridge loans that you get, and when you're getting a HUD loan, it typically takes 9 months, and that's fast for them. So you typically get a bridge to HUD. So you're going to get a 1-year Fannie Mae loan, or they actually have a nice bridge program that's in the high 4% range. So you can get a loan fairly easily, and then you replace it. So that works. Private money loan, same thing, but just commercial or residential, just put a loan on it, even if it's quote unquote all cash.
Now, are you assuming a lot of risk that you can get that loan in 9 months, or are you pretty
Well,
comfortable?
usually we're pretty comfortable doing it, and the bridge loans are not onerous. I mean, if it's a 1-year Fannie Mae loan, it's a Fannie Mae loan, so it's just a 1-year arm instead of the 5-year or 10-year fixed.
So what's the issue with buying more cash and then financing it?
Even if you closed yesterday and you're trying to get cash today, you're cashing out. So
Right.
you're pulling equity out of the property.
Right.
And they're going to underwrite it very differently. So on the purchase, they'll go 80%. On a cash out refi, they'll go 65 or maybe 70%.
Okay.
So right there, you've lost it. They're going to charge you more because now they're giving money back to you because you're cashing out. It's like, no, I'm not cashing out. I just put it in yesterday to get the good deal. Well, you got the good deal. You know, what do you want?
You're higher risk before money out.
Okay.
So how would you do that? So if you bought the property at LLC, would you lend the LLC the money
Yeah.
and do a personal note?
Yep. Yeah.
Or
I
would
mean,
you do another LLC?
do another LLC and loan one LLC to the other, and make it arm's length and pay interest properly and just make it look right. Use a mortgage broker or an attorney to do that. It's fairly easy. But residential or commercial, never buy all cash, even though it looks all cash. So, other questions? Alexa?
How do you go about finding the worst property manager in your town? Because I can't imagine that you actually call them and say, I'm looking for the worst property manager.
No. Well, you can drive around and look for dilapidated properties and look at the sign, because they're going to have a sign in front. Managed by, proudly managed by.
Probably.
I mean, the one we're buying in Dallas, we talked to the tenants. I mean, they've been running like 91, 92% occupancy when everything around. I mean, the property across the street. I've tried to go in there 4 times to look at their units. They're 100% occupied. They've never had a unit even being turned that I can look at. And these guys are at 91, 92. So, what's up? You know, and my partner, being Hispanic, goes in and talks to them. Oh, no, they're terrible. And we complain about something, or we ask for a repair, and it takes them a week to get back to us. Then we talk to the maintenance guy about it. Is, oh, my instructions are don't even address it for 48 hours, and then find out what the problem is, and then schedule it. So that's from the management down. So he's doing the best he can, but if he jumps, he'll lose his job. So you start looking at stuff like that, and you learn. But it's not really looking for the worst one, but you interview probably 20 or 30. And when you drive the properties, and they all give you a list of properties that they have, and you drive the properties and you go, oh, okay, I want to target this guy. This is my marketing. Because the worse the manager is, the more profit there is in the building. And it's amazing. I mean, I had a loan client, this was a few years back, who had a 60-something unit in Dallas that was losing money. And I was trying to get him a loan on something else. And they're going, why are you losing money? I said, well, we just, I don't know, the occupancy has been down. Well, how long has it been down? Like 4 years. It's like, okay, you need a new property manager? No, I'm going to give him a few more months. It's like, really? I mean, he's been writing a check every month to carry this. People get away, managers get away with murder. And mostly because, the guy's a busy dentist up here. He doesn't want to go down and deal with finding another property manager. And then the property manager, oh, no, this, let's give him some story, and we'll fix it. Mañana.
Yeah.
So how would you approach the owner? Let's say you found a really bad property.
Mm-hmm.
You try to find who the owner is, right?
Yep.
Property managers. And then what would you do? Like write letters to them? Or
Yeah, write a letter, call them, say, are you tired of, are you interested in selling your building? Because if they're losing money, they're burnt out, usually. So, and it doesn't always work, but it's just a letter. It's a stamp. Or we'll often go talk to managers. Actually, it was interesting because I've been a Dave Lindahl fan and a student for quite a while. And when we bought in Longview, of course, we went to visit Dave's property in Longview. And there are 22 burnt units that have been burnt for 4.5 years, and they're still there. And I'm going, Dave, what's going on? And if you think about it, if you bought this thing for, let's say, $15,000 a door, and it's going to cost you $20,000 a door to fix them, it's really not worth it.
Mm-hmm.
But then, board them up, tear them down, and get rid of the eyesore. But if you just leave them there, we were looking at a building in Fort Wayne, Indiana, which we ultimately didn't buy because we don't know the market. But this thing was 60% occupied. It was supposedly in a decent neighborhood, and this was the blight. And there were 2 buildings that had burned, and they'd just been left, and so squatters moved in, and were dealing drugs,
Oh, geez.
and so the good tenants were leaving, and they went from a nice property to a shit property, pardon the language. And we were looking at, okay, so how do we fix this? And if we had, if it were in Dallas or Houston, we would have done it. Fort Wayne, Indiana, okay, what's driving the economy, what's doing that? I mean, I don't know Indiana, I've never been there. It's one of the few states I've never been to. But it's amazing how people run things or don't run things. And sometimes the circumstance, I mean, I foreclosed on an RV park in the Central Valley 5, 6 years ago, and I ran it for a year and a half, and I could never turn it, so I just closed it, and it's just sitting. And we have a subdivision map on it, but right now there's no water, so I'm waiting for the water plant to be online next year, so then I can sell it as a development project, so I'm just sitting on it. And I had someone call me last week or 2 weeks ago, are you guys for real? What are you asking about this property, do you want to sell it? I said, yeah, I want to sell it. And he offered me like a fifth of what it's worth. I said, I'm not interested.
Where's that?
Kettleman City. So it's on I-5. It's a midpoint between San Francisco and Los Angeles. So we had made the loan originally to a guy who wanted to develop a truck stop. Because right now all the truckers are meeting their counterparts from north or south, exchanging trailers and going home, as opposed to being 6 hours one way and they have to drive 6 hours back. So, I'm just sitting on that piece of property. Do I want to get rid of it? Yeah, I do. But the circumstances are such that I'm kind of stuck. And, 3, 4 years ago, when it was still kind of operating, I might have put $150,000 into it to bring it up. I didn't have it then. So I just closed it instead. I could write a book on that place.
So it sounds like you make the appreciation play, and that's what you're going after.
Yeah.
So
Yeah.
I guess my question is, and I've heard this before, that people say stay away from LoopNet and stuff like that because people probably already rehab their property and trying to get, market value.
Mhm.
But what's your thought on just something that's already kind of rehabbed and already brought up to 100% occupancy, but it's still giving you your cap rate of 8+%? Is that necessarily a bad investment?
Yeah, so there's nothing wrong with that.
You're just not going to get the appreciation.
You're not going to get the same appreciation. So if you're happy with 8% or 10% or 12, great. I like 50 or 100 better.
But there might be a
So-
little risk, obviously, with 8%. I don't know if there's.
I don't think so.
Okay.
If I have a property that, like, go back to Atlanta, the guy has 8 employees for 138 units. You don't need that. I mean, you need 4 employees. So why do I need to run with an overabundance of payroll? Same thing on the insurance. Obviously, the seller had the whole issue with the insurance and actually got insurance proceeds and didn't rehab the units, which is why he's paying $110,000 instead of $52,000. So where's the risk in that? Well, the buyer has a solid quote, actually 152, 156 for insurance on those properties, on that same property that the seller is paying 110 for. So you take that 60K difference divided by 8 cap, do the math. Where's the risk? Okay, so whoever buys it from these guys will have a nice stabilized property getting 8 to 12% return. Very nice. I want to grow my capital. I lost too much in 08. I need to grow it again. So.
Speaking of 08, I mean, how do you protect yourself against something like that happening in the future? Just might happen again with real estate cycles. What kind of indicators do you look at?
Okay. It will happen again. Maybe not to that extent, but real estate is cyclical. It does this. So we're basically constantly looking at the markets. So if you look at Dallas, and Dallas is going, adding 120,000 jobs a year. When they're adding only 80,000 jobs a year, they're still growing. But I'm going to start looking at, okay, I need to get out because the growth is slowing. And especially with the oil going down, doing what it did, I'm really looking at Texas, Houston in particular. Midland, Odessa, I'm glad we didn't go in there.
You're looking at Texas, or you're
No.
thinking of exiting?
No, I mean, we're still buying in Texas because I think it still has a lot to go. But I mean, I'm watching the oil, and you look at the numbers. I mean, even Houston, I think 12% of Houston's economy is oil-based.
Right.
So 12% is suffering, and the other 88% are benefiting from the lower gas prices. They all got an extra $900 a year in their pockets. Actually, it was really cool. At the asset protection seminar, one of the guys that speaks there is like a stock trader. I mean, he teaches you how to, all these really cool systems to make money in stock. And so one of the first things he starts presenting, and I thought it's his presentation. I go, wait, that's my presentation. And he's putting up these properties. He says, we're at the end of 7 years of a bull market. It's like, I'm putting my money here. So I'm going, yes! And this guy makes 20, 30, 50% returns in a stock market annually. And he's putting his money in this stuff. I mean, he's still playing the stock market, obviously, but he's balancing. But no, we're looking at the growth of the job growth in an area, what companies are moving in, what companies are moving out, what's happening there. Is it a one-horse town? I mean, Tesla is building their factory in Sparks, Nevada. Does everyone want to go there? Well, okay, who else is coming in? That's like, I mean, Sparks is growing, Reno Sparks is growing, but not enough yet for me to jump in, but I'm watching it. Same thing, Longview, Texas, okay, it's growing, growing. Longview area still is fairly oil dependent, so we've pretty much doubled the equity. So I'd rather get out now before that goes soft, kind of thing. Dallas and Houston, I think, still have plenty of legs under it, but we're watching. Sorry? North Dakota, right now with the oil, pretty scary. I mean, I've some clients, I financed a hotel for them 2 years ago. They bought that thing basically at a 32 cap. They were using pre-boom numbers to underwrite. 2 years prior to their buying, these guys were getting $55 a night for their rooms, and at 60% occupancy. When they bought, they were getting $119 a night with a 95% occupancy. They bought on the 55 a night at 60. So they're fine. And they figured, we need to get our money out in 3 years, or we're not going to make it. That's how they were thinking. So they're probably fine even with the collapse. But you have to look at what's happening in the area. Like in Tulsa, for every $100,000 in rehab they're doing, we're getting a 40% tax credit. So Tulsa is revitalizing Tulsa. And there was an article a couple of days ago. Tulsa's time has come, and Tulsa used to be like the gem of Oklahoma. Now we're in talks of Oklahoma City, and Tulsa's going, wait a minute, not so fast. And they put in a new light rail system. I mean, they're really doing a lot. So when Tulsa stops investing in itself, I stop buying. So that kind of stuff. Make sense? So, other questions?
Seems like this market is also real estate, an interest rate play right now, right?
Yes, definitely.
So, as much as real estate, it's probably interest rate play. Because it seems
Yeah.
like if rates go up, then rents are gonna go up, and that bodes well.
Well, it's not as much as rents go up. I mean, the first building I bought was a 19% interest rate. A year later, things would drop to 12.5, like really low 12.5, and I cashed out. It was awesome. So, but at 12.5%, I would never have gotten the same price I got at 19%. Because yes, there is NOI, but there's also the debt service underneath that. So as rates go up, values will come down. The cash flow is going to be similar. So, the reason we're going for 10-year fix is if we can get lower price money for the bulk of it, then it's a better deal. We can sell for more. But it's definitely real estate, interest rate driven. So, anyone else? Cool. Grab some waters, mingle. So,
Is that Chris guy here?
Chris,
The guy you're talking about? Or whatever's in, who handles some of the animals?
Mike. Yeah. He works here, he's not here now.
Oh,
Yeah. But, do you have a card on you?
I do not know.
Okay. Email me and I'll, you know, I'll see what you have and we'll work on it.
Cool.
Are you looking at a property now? or-